This is Cathal Kiley presenting task 2.3 for course MBC 301, Blockchain 101 for Professor Brian Reedy. The topic is blockchain, tokenizing commercial accommodation real estate, and the task discusses whether this topic needs blockchain and proving it. Introduction. The world is becoming increasingly polarized between the haves and have-nots, where the idea of buying one's home is simply unattainable for most. Shelter is considered a basic human need, and the health of residential real estate is arguably the cornerstone of any economy. At the base of Maslow's hierarchy of human needs, we find a physiological level, which encompasses the basic yet self-preserving needs, such as sleep, water, and shelter. Owning a property provides the comfort of security, tax benefits, a hedge against inflation, and opportunities to leverage. Governments the world over are facing a housing crisis where demand far exceeds supply, resulting in upward price pressure while creating unmanageable barriers to entry. The result is a universal growth in the rental property market, particularly in large cities due to rapid urbanization. This project will demonstrate the ability for blockchain-powered technology to facilitate an easier entry to the property market, while attracting record levels of liquidity to the space. The proposal is anchored in the inherent immutability, transparency, and decentralized nature of the blockchain, and will focus on specific build-to-rent developments to highlight the disruptive potential in this sector. Background and challenges. The concept of buying a home is essentially impossible for most of those who live and work in cities. As it stands, non-accredited investors, individuals who make less than $200,000 annually and have a net worth of less than $1 million, cannot invest in the real estate that identifies our cities, as per Cooper in 2022. Traditional routes to acquiring real estate demand large amounts of liquidity and time, relationships with lenders whose requirements are hard to meet, and expensive third-party costs. These factors, combined with the current lack of supply, rising inflation, interest rates, and population levels, have driven prices to levels the average person simply cannot afford. The global housing crisis means that the majority of millennials are unable to buy a home. As per Filipovic in 2022, close to half of boomers were homeowners by age 34. Today, 75% are. By contrast, only 37% of millennials owned a home by the age of 34. Real estate is essentially controlled by baby boomers, hedge funds, and those with large amounts of wealth. All outside of this tight circle are forced to rent. London, for example, will become a city of renters by 2025, where only 40% of Londoners will own their home, new research claims as per Corrigan in 2022. Furthermore, the rents are so high that people are unable to save. Tenants of privately let homes in London are typically having to spend almost 40% of their annual income on rent, making it unaffordable to all but the highest of earners, official data suggests by Milner in 2022. Living and working in London, for example, with average savings will take at least 34 years to save up for the mere deposit on a home, meaning the only choice for most will be to become a permanent renter. What happens when these people stop earning an income? Who pays their rent? This is a common problem across the globe and will create immense challenges for our future governments. Blockchain, the solution. The value of the global real estate market is substantially higher than both the global debt and stock markets, with mid-2020 figures from Desjardins showing values of global real estate of $286 trillion, debt of $252 trillion, and stock markets of $89 trillion. With returns in real estate achieving slightly better results than stocks, they found that between 1870 and 2015, worldwide housing returns were 6.9% after inflation versus 6.7% for the stock market. Carlson, 2022. Whilst the real estate market is much bigger and gives better returns, it is substantially harder to invest in, leading to dominance by hedge funds and high net worth investors. Only 3% of the global population has invested in real estate, but over 80% view real estate as a good investment, as per Morton, 2021. Blockchain can revolutionize this market by introducing new levels of efficiency, cost savings, transparency, and trust. Tokenizing real estate involves fractionizing the property into tokens and storing said tokens in a blockchain where investors can secure direct ownership. They effectively own a tangible asset without buying or managing the property themselves. This duty remains with the developers. These tokens can be traded with ease, allowing investors the freedom they have trading any stock in any stock market. Consider a purpose-built rental development that had been fractionalized where one can buy pieces of the building in a digital token format at a price they can afford. One might not own the full property, but would own a share of it with all the legal rights afforded to any real estate investor, thus delivering the security of owning a property realizing the capital gains of such, and reaping their share of any profits from the management of the business. The result would present the individual living in London with an opportunity to buy however much of the building they can afford, accessing all the benefits of owning real estate in the traditional sense at a fraction of the cost. The problem statement and the solution. The problem is universally clear that we have a housing crisis, where it is nearly impossible for the average human to own and provide shelter for those they support. Caused by a contribution of lack of supply, increasing populations, urbanization, rising interest rates and inflation, logistical issues driving costs of materials, the COVID-19 pandemic restricting production, diminishing supplies of raw materials, but most importantly, the distribution of wealth. Average investors struggle to meet the current financial and legal requirements set forth by those empowered to purchase a property. The result is a small number of investors controlling the supply and forcing more and more people to accept the stress of being a permanent renter. I believe that the distributed ledger technology of blockchain can disrupt, revolutionize, and democratize this space, affording everyone the ability to purchase real estate. This technology can provide all with the benefits and security of owning real estate whilst de-stressing the housing crisis facing current and future governments. This paper demonstrates the power of DLT and the positive implications it has for the real estate sector. This table clearly shows, as an individual looking to buy a property, the traditional problems that we face today and the solutions that blockchain can solve. So, taking deposits from a substantial amount of money to zero, completely minimizing risk, locking up cash for as long as you want. Typically, it's years. Now it can be as long as a matter of an hour. The sales process is long and expensive with traditional purchases. Blockchain is negligible and there's no costs, no third-party involvement. Trust in the sale process requires you to trust lawyers, brokers, surveyors, whereas in blockchain it's trustless. Managing tenants is 100% on the owner in traditional real estate. In blockchain, it's 100% on the management company. And the ability to diversify. Buying an apartment now, you have to buy the whole apartment, trusting that development, the management company, at their discretion, whereas using blockchain, you could diversify your investments across a number of buildings, mitigating this risk. Furthermore, there's clear benefits, business solutions and benefits to developers, as shown in this table. The likes of additional capital, where you can get access to new pools of liquidity, including the 2.2 billion unbanked in the world, along with the 97% of the population who are unable to invest in the property market at this current time. As Rees said in 2022, even if just 0.5% of total global property market were to be tokenized in the next 5 years, it would be on track to become a $1.4 trillion market. Furthermore, they get direct access to cash. Developers can eliminate the need for expensive and intrusive banks and lenders and go direct to individual investors through the blockchain. There's immense cost savings, so removal of ongoing, inefficient, and mostly unnecessary middlemen, such as lawyers, agents, surveyors, and brokers. The efficiencies are provided through the ability to pay for each agreement once, which is then immutably written into the code of the smart contract and can be used in perpetuity. Furthermore, it's transparent. The storage of the likes of sales and purchase agreements, management contracts, agency agreements, management fees, and commission rates can all be stored transparently on the blockchain. The irrefutable records of blockchain, which are time-stamped and stored in the smart contract on the chain. This will mitigate costs with any future legal disputes. Finally, smart contract triggers. So the opportunity for developers to write favorable triggers, which can be executed at the touch of a button with no need to negotiate, agree, and sign off with each individual party. This can be applied to the likes of a buyback option on the whole investment as per agreed mechanisms in the smart contract, leveraging options, fully automated fair floor price on the exchange based on independent real-time like-for-like valuations, the ability for the developer to have the first refusal for any seller looking to sell below market price or the fair market price, and then total flexibility in the deal structure. A developer could set up the tokens to be shares in the business or zero interest funding options. They could be created as fixed interest loans and the lien could be on the token. So the possibilities are endless, and it's completely flexible for the developer. So in discussing the technical specs and how this would work, so stage one, you would define the structure. Developers would decide on the type of asset they intend to digitalize, forming the likes of an SPV, a subsidiary, or a real estate fund. Shareholders' rights would be determined as equity partners, issuing a loan note with a lien on the token, rights to dividends of the building management, for example, and further rights may be extended to the internal governance to ensure that the management operates with integrity. Smart contracts would dictate the definition of the token, along with the rights and obligations of all parties in exactly the same way as any shareholder or loan agreement would do today. Stage 2, choosing a platform. The creation of the likes of a permission quorum-based platform built on an Ethereum blockchain making full use of smart contract technology. ERC20 tokens would be issued, and the blockchain would employ the Istanbul BFT consensus protocol. Designated maker nodes would be afforded the right to create new blocks in the chain, which would be voted in by the community using quorum chain, an innovative method to achieve fair consensus across all nodes. A permission blockchain is necessary to deliver the increased levels of comfort, security, and privacy. The governance would implement a strict KYC onboarding process and maintain full control of certain components to ensure the business is legally compliant. Quorum has the power to manage two databases, a private state and a public state. The private state would wrap the whole platform to protect the users from malicious attacks, along with certain actors. This would be also beneficial for tailored agreements with the likes of sales agents, commissions, or scaled investors, for example. The public state, however, would use a distributed ledger technology to enable P2P trading under pseudonymous profiles to further improve security. A secondary exchange would be set up to facilitate this trading. Stage 3, tokenization. Assume a company is looking to develop a specific build-to-rent development of 100,000 square feet with a build cost of $30 million US. The company could mint one token per square foot at a value of $300 each and sell under an STO or security token offering. During the STO, the tokens are created and issued on the blockchain as regulated assets, similar to stocks in the stock market. Different regulators view different real estate tokens as securities or property, which would need to be reviewed in each market. The sales and purchase of tokens would transact utilizing smart contracts, which would be signed off by a credible law firm under strict adherence to local law. These self-executing contracts would outline the ownership of the real estate for the token holder, along with the obligations and any triggers between the developer and purchaser. The title deeds, management agreements, and relevant contracts would all be stored transparently on the blockchain. This structure would remove the high barriers of entry and empower anyone to enter the real estate market at manageable price points. Traditional real estate investments typically carry a long-term lockup of liquidity, where the DLT would enable cheaper, faster, and easier trades. Furthermore, this fluid trading of tokens would cost the developers neither time nor money and have zero impact on the management of the building. Challenges in summary. Innovative, disruptive technologies will always face challenges in the path to acceptance and adoption, and blockchain-powered solutions certainly have some obstacles ahead. Regulation is a concern. As soon as governments regulate this, mass adoption will occur. Education, the public needs to be made aware of this technology and how it will benefit them. And then powerful competition. Large banks, lenders, and governments stand to lose by this, the whole commercial ecosystem. And the solution is not in their interest, and one can expect strong resistance from this sector. There's also problems with blockchain, such as scalability, adoption, and the stigma associated with cryptocurrency. So in conclusion, if you look at does this sector need a blockchain, and this tree clearly shows that it does. There's definitely a need for a common shared database. There's definitely multiple parties involved in the build-to-rent sector. The parties have conflicting issues if they're trading tokens, conflicting incentives. The rules governing the participants are not uniform. There's need for an objective immutable log, of course, to track investments, and the rules of transactions do not change frequently. So all of these suggest that this would lead towards a permission blockchain. So in conclusion, blockchain is simply a distributed ledger technology at its core, which offers the ability to trade and store immutable data on a trustless network. There are many powerful use cases for this, and the tokenization of real estate is certainly one. This paper has demonstrated the fundamental process in which employing blockchain to tokenize fractionalized real estate can contribute to helping solve the housing crisis. It has the power to disrupt the real estate market, pulling down unnecessary barriers to entry and democratizing the space. Both developers and the people will benefit through the removal of expensive third parties and archaic acquisition processes.